everyone. It is May 6th. It's a Friday. And today's the interest rate update as we do Monday through Friday. A lot's going on in the market. I mean, a lot of interest, right? In people's, what's going on with housing? Are mortgages going up? Everyone's hearing about the Fed rate being hiked up, 0.5% on Wednesday. So what in the world is going on? We are going to be looking at some charts. We're going to be looking at interest rates. We're going to be telling you where they're at today. But also we're going to be looking at what's causing some of the causes of this downward cycle for the last 30 years in interest rates. So as you can see right here, that 30-year fixed right here, this downward channel, we're going to be talking about this here in a little bit. So if you're not subscribed, be sure to do so. We do this Monday through Friday. If you're a buyer looking to buy a home, you're looking to sell a house, you're a real estate agent, great channel to subscribe to. Also, a quick notification, or at least a disclaimer, this is for informational purposes only. This is not financial advice. Also, we are only licensed in the state of Arizona. We only help borrowers here in Arizona get a mortgage to purchase a house or refinance because we are located right here in Phoenix and we know this market very well. All right, so where are our 30-year fixed today? It has been the mortgage market has been stable-ish this week. We still see rates at 5.125 for the 30-year fixed, the 15-year fixed at 4.375, the 5-year adjustable rate mortgage at 4.49, the 30-year fixed FHA at 4.625, and the 30-year fixed VA loan at 5%. And here are the loan assumptions below. Again, what you'll notice if you see our channel for this whole week, they've been right about 4.99 to about 5.125. So even though the Fed rate has went up a whole 0.5%, there's not directly related. I mean, keep on covering it, but because the Fed rate is a different beast altogether. So this is a chart I like to show people since 1971. This chart shows the interest rates of the 30-year fixed going all the way up to about 18.3%. And since 1986, we've been in this downward channel back and forth, back and forth. And what caused this downward channel? And someone in the comments asked, hey, what is causing this channel? What does it make sense? Or why? And I said that this is from essentially the money printing. Every single time we add more debt to the U.S. Balance, rates have continually gone down for the last 30 years. Okay, let's look at this correlation. The U.S. total public debt from 1986 to today, this downward pressure was caused by this money printing to pay for the U.S. debt, the wars, the quantitative easing, the bailouts, and the COVID stimulus. And you'll see the recessions in the gray columns right here. These gray columns are recessions. You'll see the most recent one is a small one. That was from COVID. Here's the 2008 big housing recession, and so on. But look at how much debt. We were at about $2 trillion of debt in 1986. Right now, we're about $30 trillion in debt. All right, so it's this is related to this, okay? It's the same period of time in that channel. This is what's happened. So why? Is there anything more to the story? Let's look at the Federal Reserve rate. And I was talking about this just a moment ago when we started. Federal Reserve rate is not, directly tied to mortgage rates, but they're definitely rhyme. So the federal funds rate has been in this downward channel also since 1986, back and forth. Okay, it was up to like 18% or 19% back in 1981, the federal funds rate, and right now it's at 0.75%. All right, so 0.75, that's where the federal funds rate is. And the federal funds rate is the interest rate that the commercial banks can borrow from each other. All right, and we can go on to that. I'll probably do another podcast on that one day. But I think this is also good to know, where does Wall Street believe the federal funds rate will go? So what happens is Jerome Powell, federal chairman, and all the board of governors, have all these press releases. So you're probably listening to the radio, you're watching a YouTube channel, and someone's saying, oh, the Fed said this, the Fed said that. So a lot of times everything they say is calculated. Nothing that the federal governors or the chairman will ever say something just on the fly or just casually. It's all calculated. Every single word that they say has meaning. So the traders on Wall Street that actually trade the option traders, they actually trade based on the way that the Federal Reserve is speaking, whether they're going to be aggressive on interest rate rising or lowering the interest rates. But the point is, sometimes the Federal Reserve will give us like very clear-cut numbers. Other times the traders just have to kind of read into the words. So right now, May 4th was a couple days ago. The rate went from 0.25% to 0.75%. It's good to know. And then you'll just notice that June 22nd, that's their next meeting, 82% chance we're going to go to, it'll rise 0.75%. So you'll see these are the meetings that they're going to be having in the future. And here are the chances, the probabilities of what those Federal Reserve rates rises will be. So right now we're at 0.75%. And by February 23rd, there's a really good chance we'll probably be at 2.75% to 3.25. Now, follow this channel, subscribe, and of course, we're just going to keep you updated on this, but it's just really good to know. Because so here's the reason why this is all important. Here we go, the 30-year fix. We showed this to you earlier. So side by side to the federal funds rate. See, so here's the same channel. Here's the same channel in time. The mortgage interest rates can move much quicker. They can react really quick. And that's the whole point. I mean, it's traded on Wall Street every day. So the point is, when the Federal Reserve started talking about raising interest rates to combat inflation, they moved quick. So that's why you see immediately right here, it broke through this channel. But the Federal Reserve only meets well, they expect like 9 meetings a year. So they don't have the ability to act very, very quick. It's actually quite, if you think about it, like they only can meet like 9 times a year. It isn't like they just immediately can move, but they do influence the market. The point is, over the next year, we will see eventually the Federal Reserve, according to what they're telling us, rise above the channel just like the 30-year fix has done. But again, different interest rates, and that is how that flow works. So the lower the federal funds rate, the reason why it's so important, I know that I don't want to get too caught in the weeds, but it's like this, our federal government, they can basically set the interest rate that they pay back their debt on. And if you owe a lot of money, wouldn't it be great just to charge yourself a real low interest? That's the whole point. And right now, the interest is about $5.5 trillion. By raising the Fed rate just 0.5%, it raises their interest bill almost $1 trillion. If they raise the interest rates 1%, it raises their interest bill about $2 trillion a year, and so on. And then 2%. If we're at 2%, it'll be like $3.7 trillion. Anyway, the whole goal, and again, this is a vicious cycle. We go through this from one recession to another. Interest rates rising, interest rates lowering, inflation increasing, this is this constant battle. So I'm not going to address this today, but I do believe that interest rates are going to fall in the future, probably when we are probably in a recession right now, or we'll probably be in it in the next quarter or two. But I do believe when the Federal Reserve addresses the inflation, well, like they are now, the economy is going to slow down, and eventually the Federal Reserve is going to stop raising the rates, and they'll probably even pull back. So again, the future, are we going to have these high mortgage rates? No, I don't think for long term. But how long will it take for them to lower them? We'll go into that in a couple, the next couple videos that we'll do. So just stay with us. Everyone have a great weekend. We'll talk to you later. Hey guys, thanks for listening to the Mortgage Brothers podcast. Please let us know if you have any questions you'd like us to answer. You can email your questions to team@azmortgagebrothers.com. And be sure to ask us for a free quote on your next mortgage. We'll be sure to give you personalized service and help you through the whole process. Signature Home Loans, LLC does not provide tax, legal, or accounting advice. This material has been prepared for informational purposes only. You should consult your own tax, legal, and accounting advisors before engaging in any transaction. Signature Home Loans, NMLS 1007154, NMLS number 210917 and 1618695, Equal Housing Lender.